Hello and welcome to Nirmal Bang, ladies and gentlemen. I'm Hiral Dadia. We have with us Aditi Nair, Chief Economist at ICRA, joining in. Welcome to the show, Aditi, and always a pleasure to get you on the show, speak to you, and get insights from you.
Thanks, Hiral.
Aditi, let's start off with what the growth data is actually indicating. If you see in terms of where the real GDP goes, it's expanded by an expected number of 8.4% on a year-on-year basis in the second quarter of FY22. What do you make of this data, number one?
Well, our forecast was 7.9%, which was also the FPC's forecast for this quarter. So on the first glance, the growth data has come in higher than at least what we were expecting. But when I break it down and I look at the different components of what has grown faster than expected, the numbers are not very convincing in terms of the durability of the growth momentum going forward. So if we look at GDP, for example, GDP is just about 0.3% higher than the pre-COVID quarter of Q2 of FY20. And this is one of the metrics that the FPC has been looking at as well. When is growth? When is activity going to revert above the pre-pandemic level? So if you look at the headline number, it has, but the internals are really not that great. Consumption is still lower than private consumption is lower than the pre-COVID level by about 4%. Government consumption by about 17%. On a positive note, the gross fixed capital formation is higher, but just about by 1.5%. But the really strange bit of the data is that valuables have gone up several times. And in absolute terms, when we look at the rise in valuables between Q2 FY22 and Q2 FY20, it's about 7 or 8 times the total rise in GDP in this period. So it's not a very comfortable feeling that it's imports of gold and silver and things like that which are pushing up the GDP above the pre-pandemic level, because that is certainly perhaps not sustainable and B, not really desirable. So in terms of the internals of what has driven growth, that's not very convincing at all. On the GVA side, 2 subsectors grew faster than what we expected. One is agriculture, which frankly surprised me because the monsoon was exceptionally uneven this year. And the second subsector which grew faster than what we expected was public administration, defense, and other services. And it grew faster than both government revenue expenditure and the state government's revenue expenditure in the same period. So it's not very convincing, because we don't believe that other services could have up the number to that extent. And again, there are some questions on sustainability. But what didn't do as well as what we expected is also very important. Manufacturing, construction, trade, hotel, transport, and communication related to broadcasting. Interestingly, manufacturing, construction, and mining, the GVA growth, which is the value-added growth in Q2 of FY22, was lower than the volume growth indicated by the IMF. Which is also telling us that there is margins are already being compressed as early as Q2 with the rising input prices. And we've seen lots of producers announcing price hikes in Q3 so far because they just can't hold on. They can't compress margins further. So this has implications for how much consumption can revive in a sustainable manner in H2.
Right. So are we trying to say right now that the momentum that we were supposed to see, that has not happened, number one? And if that's the case, is that a sign of worry, Aditi?
So let me put it this way. The MPC is looking for a couple of things. One is output higher than pre-pandemic. Yes, we're checking that. The second thing they're talking about is growth reviving and sustainable in a durable manner. And my assessment is that we don't have evidence of that in the Q2 numbers. After Q2, if we look at Q3, we had a good festive season. Most of the indicators for October were quite positive, including the fact that we had record high GST e-way bills, for example. But the November data is very, very mixed. There's lots of indicators that are indicating a slowdown in momentum in November. Electricity generation, for example, electricity demand growth was just about 2%. The GST e-way bills have slowed down in the first 4 weeks of the month, which is pretty much the entire month. This is the daily average GST e-way generation that we look at. Exports growth yesterday was also significantly lower. It's still very high YOY growth, but it's significantly lower than what we've seen in the last few months. And exports were actually at their lowest level of FY22 so far. Vehicle registrations continue to contract in November. The Coal India data that we got yesterday has shown some moderation in the pace of growth, although the sequential momentum is very good because the rains have eased. So overall, I would say that we have a very mixed picture for November. And after that, we've headed into December with the concerns on the Omicron variant of COVID-19. And we really don't know, even in the immediate term, in terms of what is going to mean for restrictions, first of all, and therefore for global demand. Positive will only be if commodity prices sort of come down very significantly, because that will take care of some of the inflation and the margin worries. But that's not really, something that we are hopeful for. So I would say we've now entered into a period of very much reignited uncertainty because of the Omicron variant. After a good October and a dull November, we are now in a period of uncertainty. So durability of growth, I think, is we're not meeting the sort of threshold to say that growth is back in a durable manner.
Right. So, in spite of having a healthy festive season, I think we are not seeing the momentum that was actually needed. That's one. And two, we are seeing an increase in the vaccination coverage that's happening. However, if there is a third wave that all of us are talking about, the new strain, are you seeing a major impact that we should be watching out for?
So, interestingly, the early part of November, because of the festive season, the vaccination numbers, the daily vaccination numbers have come down very sharply. But I must say, in the second half of November, the pace has really picked up, and we're looking at much better daily average numbers in the second half of November. So I would say we're easily going to cross 90% of first doses for 90% of adults getting their first dose by the end of December. And we should be somewhere, hopefully, at 65% of adults getting their second dose by the end of December. And we're at 84 and 48% right now. So 90 plus and about 65 is what we're hopeful for the end of this calendar year. And that should mean that about 85 to 90% of adults should have their second dose by the end of March. And these, broadly corresponds to more than half of the overall Indian population.
Right.
But concern, I think, now is whether, firstly, how transmittable and tough Omicron is as a variant as compared to Delta in terms of the severity, and whether the existing vaccines are going to give adequate protection against it. And I think these are questions that hopefully in the next couple of weeks we'll have a lot more clarity on.
Right. And overall on the spending front, if you see in the month of October itself, government spending has been under pressure. Are you seeing signs of a pickup that could happen from here on, at least in the second half of FY22? Especially, both if you have to consider central as well as state.
Yeah. See, in terms of government spending, let me put it this way: the visibility on tax revenues is very good at this point.
Yeah.
We are assessing that even after the relief on crude oil, on excise on petrol and diesel, and the customs duty relief on edible oils, etc., we are still estimating that the gross tax collections for Government of India are going to be 1.8 trillion higher than budgeted. And about 60,000 crore out of that will go to the states. The rest, 1.2 trillion, remains with Government of India. This is above budget. We have an extra 50,000 crore above budget for the RBI surplus. And as of now, the expenditure which has been announced is possibly, and what we expect in terms of the amounts for Rabi subsidy, export subsidy, etc., should be about 1.5 trillion higher than budget. So we're still net positive. The concern is on whether the big ticket disinvestment flows will be completed within this fiscal year. That's something that we're not going to know until maybe March. We may not really have clarity. But the tax revenue visibility itself, I think, is something that should drive expenditure for Government of India in H2.
Hmm.
The state governments, they've had some big ticket cash flow items which have pushed up their inflows in October and November. The balance part of the back-to-back GST compensation loan was released to the states in 2 tranches in October. And in November, they got an extra sort of tranche of central tax devolution. So typically, they get a certain amount every month, and the adjustments are made in the month of mostly in the month of March after we have the revised estimate, sometimes even in February. But because it's pretty clear that the tax revenues of Government of India are going to be higher than budgeted, so are the central tax devolution. And they've been given an extra sort of monthly tranche in the month of November. And we're seeing that borrowings have been really low over the last 5 or 6 auctions. The amount that the states are borrowing every week through the RBI window, through the state development loan auctions, is trailing what was indicated in the auction calendar. So clearly cash flows are much easier in this quarter. And of course that will translate into faster spending.
Correct. And very lastly, Aditi, with all of this, now taken into consideration how growth has been panning out, how the global, the central banks are looking at tightening, sucking up liquidity already from the system, how do you expect the MPC and the RBI to react to it? Because you have the MPC policy, which is lined up now. Number one, do you think they will start cutting rates? Because a lot of anticipation was that probably a couple of decisions would start coming in now or maybe early first quarter next year. And secondly, in terms of the tonality that they maintain, do you think there could be a subtle shift that could come in?
Not so subtle shift is my view. In terms of December itself, we are expecting a status quo on rates and the stance. We're not expecting a reverse repo hike from the RBI this time around, and we're not expecting the MPC to, for the vote to shift to changing the stance. We expect it to be a split vote like the last 2 policies, but we expect it to continue to remain accommodative in the December policy. There will be more discussion on the renewed uncertainty for sure, but we do think that the MPC document and the RBI, any supporting releases which come from their side will start laying the ground for a possible shift in the stance and in the reverse repo rate in the February policy. And that's what we're expecting, that the stance will be changed to neutral in the February policy. And this will be accompanied by a 15 basis points reverse repo rate hike from the RBI. And then if there are no sort of intervening lockdowns, then we expect the repo rate to be hiked by 25 basis points each in the April and the June policy reviews of next year. Inflation is something that, there's been good news and bad news. The last 2 prints were significantly lower than what we were seeing until the previous policy review in October. And the big good news is that the excise duty cuts on petrol and diesel were also then followed by the VAT cuts by the state governments.
Correct.
But commodity prices up until the Omicron uncertainty were very high, and we have seen a lot of producers starting to increase prices. So the outlook for the core inflation remains quite concerning. And while the Rabi, sowing is taking place on a very brisk pace, but vegetable prices have also gone up, and once that happens, they tend to stay uncomfortable for a few months before reversing. So we are still expecting to see CPI inflation in the range of 5.5% to 6% between December and March. And the average for this year could be 5.5%, which is higher than the MPC's last forecast of 5.3% for FY22.
Right. And very lastly, Aditi, what's the kind of impact we could see, or what's the range we should look at in terms of the rupee and the bond deals with everything that's circumferencing it right now over the next, say, 3 to 6 months?
So let's talk about the next 4 months, for example. Okay. If we talk about the rest of this calendar year. For the rupee, we still have a lot of IPOs, etc., which are being planned, and if substantial amount of money comes in through those, or if Indian bonds get included in the global indices, then that could certainly pull down both the yields as well as the rupee in terms of appreciating the rupee. But otherwise, we would expect dollar strength to be the dominant factor. And in terms of a range, we would expect the rupee to sort of trade between 73 and a half and maybe 76, just in case there are a few days where the Omicron related uncertainty is at an elevated level. But otherwise, 75 and a half is broadly what we expect to be the top as far as the rupee range is concerned. For the yields, the 610 has already gone up by about 25 basis points since it was introduced a few months back. And as we get closer to what we think is going to be an April liftoff for the repo rate, and as the market expectations around the repo rate hike start to crystallize towards what we think is a likely liftoff in April, then we could certainly see another 25 basis points increase in the 10-year. We don't expect there to be too much of sort of yield management or liquidity support to keep the 10-year down going forward, because the RBI is going to only, focus further on liquidity, reducing the liquidity surpluses. So we don't expect there to be too much sort of support coming from that aspect. And therefore, as we get closer to the repo hikes, we do expect the 10-year yield to go up by maybe another 25 basis points by the very end of next quarter.
All right. Thank you, Aditi, so much for joining us on the show. Always a pleasure to get insights from you. Thank you. Stay safe and speak soon.
Thank you, Hiral.
Thank you.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.